Well, getting a move on then, and the talk of the town has also been the Zomato IPO, as the food delivery platform is set to hit the markets, filing its draft red herring prospectus with the market regulator. Let's talk a little bit about the overall valuation picture, what the incubating food ordering culture is in India versus globally. Bhavin Shah of Sameeksha Capital now joins in to discuss just that. Bhavin, good to have you on board. Now, while Zomato has been on a very strong trajectory in its overall revenues, it is a loss-making entity both at the EBITDA level as well as at the net profit level. Given that it's valued at close to $5.4 billion, what do you make of this valuation, taking all things into account as to how the food delivery space will be impacted by COVID, how global peers look like, even though it's not a like-to-like comparison?
Yeah, so, I think Zomato is obviously one of the two, main food delivery service companies in India. So, it's a duopoly structure as of now, by and large. And so that's what goes in favor. Clearly, they are meeting a need that is there. But, I understand there is a lot of, excitement in the sector, let's put it that way. We are seeing how these valuations are being given to startups, to private equity fundraising and so on. So all that backdrop is there. And one is also willing to understand that, this kind of businesses have potential high operating lever. So as the business scales up, costs don't go up in the line. And as a result, one can't look at the profitability today, but what it will be in 3 or 5 years. So one understands all that. But there are some important things that I like to point out about Zomato from whatever limited information they are releasing in the DRHP. Now they might be releasing a lot more information in private meetings to institutional investors. That is something that SEBI has to look at and sort it out. But they haven't done that. But so let's keep that in mind. They have in their DRHP. They have given very limited quarterly information, and given how FY21 has panned out with so much variability in activity level because of pandemic, more proper detailed quarterly financials would have been helpful for FY20 and FY21. Now let's look at FY20, their revenue base, and you look at 9 months of FY21, what they have given. That is, that's showing a clear decline. But, we want to give them, obviously, we want to compare apples and oranges. I don't want to compare apples and oranges. So you look at third quarter of FY20 versus third quarter of FY21, the revenues have grown only 7 or 8%. And I use those 2 quarters because we know that those are both relatively normal quarters. I also have heard, and I would like the company to come and confirm this or deny, that February 20 to February 20 revenues were flattish. So there seems to be lack of growth, at least as of now, in the business. In future, the growth might come, but we don't know. Now, if you look at the multiples that are being talked about, and I've heard various figures in the market, you were saying 5.4 billion. I've heard figures like 7 billion, 9 billion. I don't know what the number is. But the fact is that if you take FY19 as a base, that revenue is 350 million. You could even annualize like a normal quarter revenues in FY21. I'm sorry, FY20 as a base, that revenue is about 350 million rather. So what multiple do you apply on that? Well, the biggest company in the space, the Chinese company Meituan, I'm not sure about the pronunciation, but anyway, it is trading at something like 17 times enterprise value to sales, and I could be off on these numbers, but it's somewhere in that range, and it's hugely profitable. If you go down to DoorDash, whatever it's called, it is around 12 times revenues. And if you go down to Grubhub, it is about 3.5, 4 times revenues. Now, why am I mentioning all this? Because let's accept for a second that there is operating leverage in the business. So right. If there is operating leverage, it means that the larger companies...
what I wanted to actually get in your view on... Yeah. Bhavin, apologies for that interruption. We're a bit short on time, so I wanted to get in your view. Just interestingly, a short while ago, we were talking to Gautam Mago of A91, talking about how on the heels of Zomato, this opens up for a lot of other internet companies as well, and food delivery companies, etc., to list on the stock exchanges, and that now the Indian capital markets have been more accepting for newer type of companies with stronger unit of economics, even though they are loss-making to list. Is that a worrying factor? Because the company has a history of net losses from FY18 to 20, and they have said that they also anticipate increased expenses in the future. From an Indian stock capital market perspective, how are you looking at this dynamic?
Well, fundamentally, it seems to be grossly overvalued by many times over. And even if I want to believe in the growth story, there are some signs that growth is not coming of late. Even profitability has dipped in third quarter. If you look at contribution margin as a percentage of gross order value, it has come down. So, and they're not giving more information than what they've, it's a very limited information they're giving. So overall, it is grossly overvalued. However, in what is happening in the global markets and what is happening in the space, I mean, Zomato might get bumper listing. It might go up in the post listing, but that is the nature of the market right now.
Okay, so you're still expecting a bumper listing despite what we're seeing, and the fact that you think that is grossly overvalued. Just give us a sense as to what the outlook is when it comes to the major challenges that present itself, apart from COVID as well, for this sector as a whole. The fact that, adding new customers in a cost-effective manner, if it fails to add new restaurant partners, delivery partners, retain its existing restaurant partners, or even its customers, all of these emerge as huge risks for the company. Any other that you'd like to flag off, or what you think is the biggest?
No, I think, clearly we need to understand why they are not growing. Even in a normal period, why they are not growing. That's something we need to understand. Because, while if the whole story is about operating leverage, that only comes with high growth. What you mentioned, all these factors, which are resulting in very, very high cost increases. How do you tackle that? In Indian context also, you have to deal with a lot of inflationary factors. There is going to be very high wage inflation. Fuel costs have risen very sharply. So that that will also feed into the kind of delivery charges that the delivery partners will expect. And I think so those are also the factors. And obviously now they are working on other types of business models. They want to supply raw material to restaurants. How that how much investment will go into that and how successful is that, and what is going to be the competition like in that space. That also needs to be evaluated. So there are a lot of questions today, and I think the kind of information that company is giving is very, very limited and very selective in the DRHP to answer those questions.
And Bhavin, given that we're talking about these valuations in the range of 5.4 to 7, as you said, $1 billion, what does Zomato's listing do as a precedent for other companies within this space, like tech companies or internet companies that are looking to list? Because there is going to be a number of them hitting the capital markets over the next few years.
Yeah, it will obviously, till this kind of lasts. Till what we are seeing, this, this hype in the sector, till it's there, you will see other, companies also trying for similar listings. And as long as there are characteristics of a company enjoying a very strong market position, people will be willing to take those bets, thinking that, the story will play out over time, and then, that's how the value will be realized.
Sure. The only thing, Bhavin, here is that most of these companies are not as profitable as the valuation being ascribed to them. How do you think the two would actually meet?
Well, I think, we have I've been looking at technology sector for a very long time. We went through the 99-2000 .com crash. So one way to meet is that there is a crash, and the value, those two things eventually meet by that. So that's one. And I think even that is, in my view, the most likely scenario. The less likely scenario is that some of these stocks don't perform for many years, but they are still good businesses, so they survive, and eventually those two things meet. So those are the only two possibilities I can see.
But do you sense any sort of crash impending at all? I mean, much has been talked about as to how FANG stocks as well in the US are, richly valued, and there is that impending correction. Nothing has happened. There's only much fanfare and much enticement in the market with regards to anything to do with technology, and especially back home, these specialized IT companies, if you can call them that.
I think there are two to three things to say there. One is the FANG stocks, especially, the leaders, they're printing very solid numbers, right? Google delivering 35% growth at that scale, for example. So, that I think is something that is supporting, the market with respect to that. Second thing is that ultimately this is boiling down to availability of money at a very nominal interest rates, and furthermore distribution of cash. In countries like US, there was more distribution of cash to people. So all that continues. This party continues. When that reverses, there are already signs. Even in US, of inflation in some product categories, and at some point, the reserve banks will have to act. And if that leads to a sharp rise in interest rates, then we'll see what happens to this. Now, obviously, you could construct a third scenario to answer your question, that these companies will generate so much profits, that this valuation will eventually be justified. I mean, yeah, that can happen, but I think it can take a very, very long time. We are trying to pay for what might happen 10, 15 years from now today.
Sure. Okay, fair point, Bhavin. Great to have you on the show, and always good to get in your insights.